All right, looks like apartment bubbles are bursting in the mega cities. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Today is the 14th of January. Randy Patrick here putting the realism back in real estate. Yeah, a lot of distractions going on the past week plus. I get that, but you know what? Real estate and business must go on. That's why we're back to getting some videos out today and probably a few more as the next few days goes along. We're really going to look at different things, that support where the housing market is trending. But first of all, if you're not already a subscriber, if you could certainly help my channel grow and smash that subscribe button, I would be most appreciative. So thank you. And thank you to those who are already subscribed and who are always watching and providing their insight and their comments. It really is helpful, and it makes doing this channel all the more worthwhile for me. So again, apartment rental bubbles bursting in mega cities. And when I mean the mega cities, I'm talking about the U.S. mega cities. I'm not talking about, a London, UK, a Vancouver, a Munich, Barcelona, whatever, those type of cities. We're just talking about the U.S. right now. So we'll get into that. And what we're really seeing here is some decrease in prices. So this is from Zumper, and I'll put the link to this to the website that shows all this information in the information section of the video. But we can see that these are the top 10 price points for one-bedroom median rents across the country. You got San Fran number 1, New York number 2, Boston number 3, San Jose number 4, LA number 5, Oakland number 6, Washington number 7, San Diego 8, Newark, New Jersey, surprisingly enough, number 9, and Santa Ana, California, number 10. So we can take a look at the price point. So do a quick look here. Let's just take a look at San Fran and New York, $2,660 and $2,410 for those two. Now, if we go to this next slide here, which is this time last year. So when Zumper put out this report this time last year for one-bedroom median rent prices, $3,500 in San Francisco, $3,000 in New York City. Boston was $2,590, Oakland $2,500, San Jose $2,450, LA $2,260, Washington $2,260, Seattle $1,890, San Diego $1,790, Miami up number 10 at $1,740. That's pretty expensive for one-bedroom median rents in these mega cities. Now, but if we do a side-by-side comparison, well, look where San Fran's gone from $3,500 to $2,660. Pretty big-time jump or decrease, right? New York's gone from $3,000 to $2,410. Boston's gone from almost $2,600 to basically $2,150. So we're seeing some major jumps. Everything is losing. If you look on the right in 2020, Seattle and Miami have actually fallen out of the top 10, and you got a couple new players, Newark and Santa Ana, who are actually in the top 10 now. So what's going on here? So we're seeing obviously trends and shifting, to what's happening. Now, what's the reason for this? Well, we're not too sure. There's obviously many factors. And what I find with housing is that we're never going to have one pinpointed reason to say this is why things are going on and this is why the numbers or trends are playing out. Usually it's a multitude of factors or issues that are happening in various locations, states, the local economy, etc. Now we have COVID as well too. So, could it mean that people are leaving, apartment complexes and going to more remote locations out of the city, from urban into suburban or sub-rural? Are they going from apartments to duplexes, to single-family homes, to less densely populated locations and living quarters? So we don't know how this all plays out. I'm assuming that there's a lot that are going into this here, obviously with ability to work at home too, because I know a lot of the San Fran and New Yorks, if you don't have to work in the office, your offices are closed down, why stay and pay that huge number? So there's probably a multitude of factors that are playing into this, but the whole point though is that we're seeing some pretty significant drop in prices for these locations. Now, from a perspective on a whole, we're seeing that the purple line is the two-bedroom median price, and the blue line is the one-bedroom. So we're actually seeing the two-bedroom. We could see where they both kind of took a little hit, beforehand, sort of like, as the summer ended, etc. Now, the two-bedroom has increased in price point, but the one-bedroom has actually faltered in price. It's lost some price point. Just interesting to note. Now, again, with two bedrooms, was it cheaper to jump in with a roommate and share the cost of a two-bedroom? It's probably cheaper than having a one-bedroom all to yourself, but again, depends on the demographic, the location, the job, everything that goes into where you live and where you need to your accommodations, etc. So there's a lot of factors. Again, we can't pinpoint or explain, but interesting to see the trends and where they're going. Now, this is a heat map, and what we're looking at here is the orange dots. The darker the orange shows and the bigger the dot, in this case, shows the decrease in volume of rents that are losing rental value, decrease in median rent. Whereas as it goes to the blue, and the darker the blue and the bigger the dot, shows the increase in rental opportunity and price points, etc. So we can see that a lot of the mega cities on the West Coast and the Northeast are dropping in price point, and then we see that it's shifting to the inland on the West, it's shifting to the Midwest as well up on the Northeast, and it's also shifting to the South as well. So we're seeing relocation, we're seeing trends in price point changes for rental markets. Which is this a precursor, or does this trend also mirror what's happening in housing? Well, a lot of times it does, and occasionally, when you see something like this, it could be a sign of things that are going to happen down the road. But just interesting to note when people say, well, where are people moving to? Well, we saw my 2 videos ago, I talked about emerging markets. A lot of that was inland, Midwest, and South. And then we took a look at the U-Haul video, the last video, where people are relocating. And again, we saw people going from the West, going from the Northeast, coming down to the Midwest and the South, and the Texas area as well, too. So, all this kind of shows that things do add up. So there is a very big correlation. Price point, relocation, movement of people, new price point gains as opposed to price point loss and rental accommodation needs and requirements. So that's what the scoop is happening here. Now, it's funny, when you take a look what they're saying here, it says looking ahead in the expensive markets. The list of the country's most expensive rental markets may look quite different from 2020, which we know it does, or even the past few years due to price trends that came about in 2020. Previously hyper-expensive markets like San Francisco and New York City could be overtaken by lightning fast-growing cities like Newark, New Jersey, or expensive cities that have resisted the decline like San Diego. But there are also reasons to expect that not to happen. So when the incredible growth of places like Newark and the resilience of places like San Diego can likely be attributed to renters flocking to these places from nearby hyper-expensive markets like New York City and Los Angeles. If the hyper-expensive markets that renters abandoned in 2020 drop so low that they cease to be hyper-expensive, then it's reasonable that renters would return to these markets and prices would stabilize. New York City and Newark present an interesting example of this phenomena. How does New York City have a drop to the massive migration of renters out to Newark? If New York City and Newark were the same price, which city would we expect renters to flock to? Questions like these would likely determine the top 10 most expensive markets, what they'll look like in 2021. So yeah, like I look at it going, you're leaving New York, so New York is decreasing in price point because you're running away. But if you're going to Newark, and then of course Newark's going to go, okay, great, I'm seeing more need, and I'll have less accommodation, therefore I can mess with some price points on our rental rent rates, and I can push those up as well too. So it's a shift. Now, will Newark probably always net out less rent or less expensive than a New York City? Probably will. If you're, and again, I'm not from there, I don't know, but from when I look at what I read about, a lot of the cities shut down. There's not a lot of, restaurants can't open. All the theater districts shut down. All the things that make New York, New York. If you can't do that, then what's the point in staying? If your corporations or your employers are leaving the area as well too, then there's no point for you to stay. Well, maybe you don't want to move to Florida or someplace else, but going across the river to save, maybe $500-$600 a month in rent and having that money back in your pocket when you don't even have to commute to work. That could be attractive to a lot of different people out there. So this is where we're going to see kind of these phenomenons going on across the country. Notable changes this past month, and we'll get into a list in a second here. You got Richmond, Virginia saw basically a median rent increase the most from the prior month, up 8.3%, and it's the 28th most expensive market. Newark, New Jersey, and Colorado Springs, Colorado tied for the second highest monthly growth rate at 8.1%. Plano, Texas, and Virginia Beach, Virginia, both saw median rents climb 5.3% from the prior month. Norfolk, Virginia, increased to 5.2%. Detroit, Michigan, had an increase of 4.9%. It was the 77th most expensive rental market. So that's where changes are happening. And again, these are month-to-month changes. So we're not even talking year to year. We see that when I show that to you, you'll see how expensive some of these places have increased, how much they've gotten. But again, these are pretty substantial month-over-month price increases on rents. Now, downward, Raleigh had the largest decrease of negative 5.4% month to month. Pittsburgh was next. Durham, North Carolina, which is really beside Raleigh. Raleigh. Chesapeake, Virginia was down, and Philadelphia, Pennsylvania was the fifth largest decrease, and median rent at negative 4.9%. So we see these things happening. Now, this, again, is why I'm putting the link in the information section of the video, because you're probably going to want to look at this closer. This is the best I could bring it up without making more and more slides. But you can take a look at the top 10. San Francisco, year over year, and I'm just going to focus on there's the price point month over month, year over year for the one bedroom, and there's the same thing for the two bedrooms. I'm just going to go down the one bedrooms for now. You can take a look at this in greater detail, or slow it down, or stop it for the two bedrooms. But you can see for San Francisco, down negative 24% year over year. New York down almost 20%. Boston down 17%. San Jose down 14.7%. LA over 13%. Oakland down 22%. Washington almost 15%. San Diego, not a heck of a lot. It just had a marginal growth of under 1%. But bang, Newark, New Jersey's year over year was 30% growth on the rental rate, on the median rent. So that's pretty huge. Santa Ana was 5.6. Lauderdale 4.3 growth. Miami negative growth. Providence, Rhode Island. So look at Providence, okay, up 14%. Look at Sacramento, up 10.9%. So we can see that most locations are having, reasonable growth rates, but some locations are the most expensive ones are dropping in a double-digit scenario here, and then we've got some outliers that are popping up. So Providence, Rhode Island. Well, where are people coming that are going to Providence? Probably the Boston area, right? That's how I would see that. So if Boston's dropping, people are going someplace else, and these I call them metro bubbles. That's kind of the thing I'm calling things now, is that we're having specific bubbles in specific cities under specific, whether it's rental or whether it's home price, and we can see how, some of them are actually bursting or decreasing, and then other locations that are nearby are the benefactors of that, and they're increasing. So it really is kind of a shift. It's probably all going to even out in the end, ultimately, but it's interesting to see how this is kind of shifting through. Next level here, Richmond, Virginia, up 16%. Henderson, Nevada, up 11.4%. So if you're leaving Vegas, Henderson is a suburb of Vegas. St. Petersburg, Florida, which is I'm across the bay from St. Petersburg, up 25.7%. And, why is that? I don't know. Well, actually, I do know. St. Petersburg has done a lot of, we'll call it downtown core improvements, increased nightlife, increased I guess you could say restaurants, shops, bars, things to do on the waterfront where the downtown core is. So it's become a lot more interesting. So St. Petersburg as a whole has increased. And also, it's Florida, so we're getting people relocating to Florida anyway, right? Nashville's dropped 9%. But look at Virginia Beach, that's up 19%. Cleveland, one-bedroom rents are up 25.5% year over year. Fresno up 17.2%. Boise up 13%. So, as I mentioned, we're seeing changes. Pittsburgh down 10.7%. So really, it's sort of shifting back and forth, and I look at it going, it's almost like secondary markets are increasing. Chattanooga, Tennessee, up 14%, right? Indianapolis up 22% year over year. St. Louis up 22% year over year. And Spokane, Washington up 17%. So again, it's I know I say the word again a lot, but it's just reinforcing of what's happening. We're seeing different locations grow for various reasons. And if you want more information, I would suggest maybe checking out what is the big business driver in the city, what is unique about that location that people are relocating there or flocking there that are causing these one-bedroom median rents to increase. And the last little bit here, clearly you've got Detroit at the top there, almost 20%, 19.4% year-over-year increase on the one-bedroom. And look at the two-bedroom, it's actually almost 26% increase, so pretty substantial. Going down to Albuquerque, up 11.4%. You've got Tucson, 13.4%. Now, I don't know whether Tucson would receive people who are leaving Phoenix. Let's cash out of Phoenix and go to Tucson. Is there that big a difference in price point that you're getting more bang for your buck in Tucson? I'm not sure. That might be the case, but we can see how it all goes down. And obviously, this is really this chart is the, we'll call it like the 100 metro locations, most expensive to least expensive. So Akron, Ohio, a one-bedroom median price is $580, whereas you're going up to the top in San Francisco, it's about $2,660. So that's your distribution of pricing points across the nation here. So clearly, I'm looking at an El Paso, a Shreveport, a Tulsa, Wichita, Syracuse, Omaha, those things. Like I look at those as they're not, they're great cities, but they're not the mega cities, and they're not in proximity to receive, we'll call it, people fleeing the mega cities for whatever reason. So this just interesting to see how that works out. So really, we are kind of seeing a apartment bubble burst on the mega city side. So the most expensive price points are bursting, and they are going to have to readjust to either retain or attract more people. And quite honestly, as time goes on, what we don't always understand is that a lot of times apartment complexes or landlords will offer incentives, move-in expenses free, waiving certain things free, first month free, 13th month free if you're in for a year lease. So there's things that they do to attract people as well. So we're not sure, exactly what all those incentives are and how they play into here. This actually came out from Adam Data Solutions as well. So they actually have a report. Funny enough, that comes out almost the same time. I didn't really want to get into it here because we talk about that in some of my other videos, but they talk about the rental market for single-family homes, where the Zumper report is based on apartments. But either way, wage growth outpacing rent growth in 81% of the market. So whether you're renting a single-family home or apartment, wages, I guess, are outpacing rent growth, which is interesting. So that means, if stuff is dropping, then wage growth, if you're growing at a faster pace on the wages, then more people can afford these apartments as their price points are going down, which is interesting. And home prices rising faster than wages in almost 2/3% of the market. So we know the home price is a different marketplace, but I just found it interesting going wage growth outpacing rent growth, because if we are seeing the larger cities having decreases, then and they're into negative rent growth, then obviously wage growth will pick up. So it's kind of making sense in that capacity. But when you have the outliers like a Newark that's 30%, and that's big numbers here. So we'll see how this hashes out as time goes on. But interesting to see how, again, the numbers play out and things do make sense when you take a look at it. Now, I always talk and go, is this a precursor of things to come? Well, usually it is. Usually it's a sign of something is happening in the marketplace. So my position is metro bubbles are bursting and inflating. And I don't know the name. I didn't look at it before the video here, but somebody was asking me on a number of occasions going, Randy, what's the housing bubble doing? Is it bursting or what? I forget the exact word in the question. Well, has your narrative changed? Well, first of all, I don't have a narrative. Well, actually, everybody has a narrative, but my narrative is not the typical what you see in the media narrative. My narrative is, how can we find cheaper accommodation, whether it is for rental property or to purchase or to invest in? That's my narrative. But what I have changed, and I've said this on a number of occasions, that we do have a housing bubble. Are we in a bubble? Yes. Am I the only guy saying there's a bubble? No. Do the numbers show it? Yes. Do other much smarter, better educated, better paid economists and analysts say that we have a housing bubble? Sure we do, and that can't be disputed. But what we're seeing now is we're seeing what I call the metro bubbles bursting and inflating. So we're going to see the mega cities start to lose value. And if it's starting with, I always look at it going, if we're seeing it on the apartment side, we're going to see it on some other rental sides, and we're going to see it eventually on the housing side. So usually something that's bursting is a precursor for more to come. The metro bubbles are bursting. So, you may lose in a San Fran, but you may gain in a Sacramento. You see, that's just an example of things. So the larger cities will sort of lose, and some of the urban and secondary cities will probably gain just because of the population shift. And then they're taking their cash or taking their money out of their mega city, larger city, going to a tier 2 or tier 3 city, and then propping that market out. But obviously we'll see housing and rental markets are shifting, and it's going to manifest itself as the months go on for 2021. So as I always say, there are properties available right now. You just have to look, have to know where to look. And really, it's distressed sales. I talk about this. This is my narrative, to be quite upfront with everybody here. And why do I say it's my narrative? Because if you want to find a good price property, you got to go to the locations where people don't play. So I talked about this a few videos ago, probably last month in December or November. I forget where. And The reason why I'm bringing this up now is that this is auction.com on a webinar that I just sort of captured the slide from here. And they were talking about on this webinar 1.8 million to 2.3 million completed foreclosures between now 2021 and 2025 for about a 5-year pace. You can take a look at the right-hand bottom part of the chart where there's the blue changes to like a lighter blue, and see how that sort of wave kind of grows. And this is a monthly type of volume thing. So we're tight right now, but as things open up, we're going to see a lot more foreclosures happening down the road. Well, this number was revised, and I couldn't find the slide, but the other discussion that came after this was further adjusted to 2.5 million to 3 million foreclosures happening based on where things are tracking, the numbers, etc. That's the expectation over the same 4-year, 5-year time frame. And what we're not even accounting here is another 1.1 million plus, like at least 1.1 million plus delinquencies that are in any sort of stage delinquencies in foreclosure that are not in any forbearance plan. So, if we're looking at 2.5 to 3 million foreclosures, right now we've got about 2.7, 2.8 million people in forbearance. These 80% of the people that are in forbearance are on their subsequent forbearance plan, which means they couldn't cure their situation after their first forbearance plan based on economy and job stats, whatever. These people may not be able to cure in the future. So all these, this great talk earlier this year about how forbearance is going to save the housing market probably is not going to happen the way some of the pundits have reported it. So when you're adding 2.5 to 3 million foreclosures to the 1.1 million delinquencies, and again, when I say they're not in any forbearance plan, that means they have not called their lender for help. Do they qualify? Who knows? But they haven't called their lender for help, which means if they continue on this path, they will fall into the foreclosure bucket. And so that's the game plan right there. So that is, that's significant volume, folks. That's where opportunities lie. And this just came out the other day. Obviously, I look at Adam Data Solutions, auction, whatever. So this guy, Darren Bloomquist, I don't know him personally, never talked to the man, but seems like a decent guy when I listen to him on the webinars and things that I attend. And he put this out saying, again, he's VP of Market Economics at auction.com. And he said short sales and other pre-foreclosure sales are poised to become a more dominant share of the distressed market in 2021 and beyond. So that really is what it boils down to. Pre-foreclosure sales hold great promise as a potentially less disruptive alternative to foreclosure. It does. 99% of the time, a short sale is better than a foreclosure for the average homeowner. So keep that in mind. So, if I go back a couple slides, it's the expectations. We're going to see all this foreclosure stuff coming. And now we've got a guy here who's part of the data solution family and basically saying, well, this is how, we're going to be able to stop some of these issues and help these homeowners out. It's through short sales and pre-foreclosure sales. So, I'm talking about this and I don't want to sit here and pat myself on the back, but clearly this is where things are going. And for those of you who are the early adopters and have already got into the game or are learning it right now, good for you. Those that are on the hedging on the fence here, get in now. And those who aren't thinking of this, maybe you should start thinking about this, because the number one question I get from people when you guys email whatever is like, hey, I'm looking for a property and you give me your laundry list of all the great things you want. I don't want a pool, or I want 3 bedrooms, 3,000 square feet on the water, blah, blah, blah. I'm not trying to make fun of you here, but listen, okay, that's great, but you want it for 50% on the dollar. And that doesn't exist right now, all right? Until this stuff starts happening, that stuff doesn't exist. And it's not going to exist until people take more, do more work to get their hands on these things, because this stuff does not materialize out of thin air and suddenly become an off-market deal that I can present to you. Okay, it's just there's a lot of work that goes in to getting these properties to come to the surface and secure them, and then of course everybody wants to buy them. You see, so that's why I'm saying to everybody, get involved, understand this, figure this stuff out, because this is where you'll be able to buy a property at a much cheaper price before the masses and before it goes to auction, etc. All right, so enough of that. So I'm seeing some new trends. Spoke to my attorney this week. We had a great discussion about things. I got some new ideas and stuff we're going to focus on. Find out what's working to make money in real estate. Also, seeing a lot of stuff happening now. I'm getting access to off-market REOs. As a matter of fact, just before I went to record this video, I looked at a call and a text that I missed as I was setting up here from one of my contacts saying, We need an updated NC&D, which is non-compete, non-disclosure agreement, and some of your new proof of funds. So basically, they're going to have properties for me, which is great. So we have access to off-market REOs. We're getting those right now. We have access on a daily basis to other properties that are off-market. Some are distressed, some are just for sale, and we also have multifamily and other commercial properties as well too. So if this is interesting to you, re-engage with me or engage with me, and we can figure out how I can help you. So again, I'll tell you all about what's going on. Connect with me, Randy at luxuryshortsales.com. Drop me a line and we'll communicate and we'll talk and we'll go from there. So anyway, thank you once again for the views, likes, comments. Appreciate the patronage. Appreciate everybody who diligently watches and provides good insight and the intel across the country, which I really appreciate. So have a great day. Well, let's hope 2021 is better for everybody on all levels, and look forward to speaking with you soon. Thanks.